Welcome to this explainer. Grab your spreadsheets because today we're stepping into the shoes of a professional equity analyst to conduct a rigorous stock valuation. We're putting on our financial detective hats to look at a company that completely defies traditional financial gravity. We're talking about Nuvalent, trading under the ticker symbol NUVL. Now, if you've ever tried to run a standard valuation model on a biotech or pre-revenue company and found yourself just scratching your head, well, this explainer is absolutely for you. Let's unpack the fascinating, logic-defined metrics behind this company.
Okay, let's just jump right into the deep end with a truly staggering figure. $0 and 0 cents. In the business world, especially when we're modeling out companies, we are used to seeing millions, billions, or hey, at least thousands. But this right here, this is the total trailing 12-month revenue that Nuvalent generates today. It's not a rounding error. It's not a temporary dip in sales. Absolutely nothing is coming in at the top line. Zero commercial sales. And yet, $7.854 billion. This is Nuvalent's massive market capitalization as of our latest data. So as analysts, this presents us with an immediate and spectacular financial mystery, right? How does a company with literally $0 in revenue command a valuation nearing $8 billion? It's a complete paradox that basically forces us to throw out the standard valuation rulebook.
To start making sense of this, we must first look at their exploding stock returns.
Because obviously the market isn't just blindly handing out an $8 billion valuation, investors have been actively bidding this stock up. The stock has posted massive double and triple-digit yearly returns. We're docking up a staggering 147% in 2023 alone. In 2022, it was up over 56%, and in 2025, another 28.5%. The stock price is behaving exactly like a hyper-growth tech company, just climbing this mountain of investor optimism, completely ignoring its lack of actual sales.
Placing these two metrics side by side creates some real cognitive dissonance when you're trying to calculate intrinsic value. On the left, you've got a phenomenal 5-year total return of 428%. I mean, if you invested 5 years ago, you're thrilled. But on the right, the fundamental reality hits you. A trailing 12-month net income of negative $425 million. You have skyrocketing long-term returns juxtaposed with hundreds of millions in trailing net losses. The divergence between price action and fundamental profitability is just breathtaking.
Which brings us to the reality of zero.
To truly understand what kind of machine investors are funding here, we can't gloss over the unprofitability. When we anchor on the number 0, the reality sets in for our models. It's not just current revenue. The 3-year and 5-year revenue compound annual growth rates? 0. The gross profit margin? 0. The net profit margin? 0. And if we try to run a dividend discount model, well, they return 0 dividends to shareholders. It is a baseline of 0 across the board.
And actually, they aren't just sitting still at 0. Instead of making money, they are actively burning through a staggering $275 million in free cash flow over the trailing 12 months alone. This is the cost of operations, research, clinical trials, and keeping the lights on, all without a single dollar of commercial cash coming in the door to offset it.
So, let's talk about navigating negative valuations.
What's really fascinating here is how these massive losses completely warp all of our standard relative equity valuation models. If we try to compare them to peers using multiples, we get a price-to-earnings ratio of negative 16.93, an enterprise value to EBITDA of negative 15.65. But look closely at that return on invested capital, an astronomical negative 566%. For every dollar invested, the current operational burn is magnifying the loss incredibly. In literally any traditional sector, these metrics would send investors running for the hills.
In fact, the fundamentals are so inverted that our standard absolute valuation models break down completely. If you try to run a discounted cash flow model, you need positive future cash flows to discount back to present value. As we saw, they're burning $275 million a year. Because Nuvalent lacks both cash flow and dividends, their fair value price literally reads as not applicable in the data. You simply cannot measure the intrinsic value of this stock using current fundamental outputs.
But they do have a debt-free safety net.
So how does a company burning hundreds of millions of dollars avoid bankruptcy? Here is our magic number 0 again, but this time it's a massive positive for our asset-based evaluation. Nuvalent has a debt-to-equity ratio of exactly 0. They owe nothing to long-term creditors. There are 0 crushing interest payments accelerating their cash burn.
They are entirely equity funded, which is absolutely crucial for their survival.
Beyond having zero debt, we also need to define their current ratio. As a quick refresher, the current ratio tells us precisely how well a company can cover its immediate, short-term financial obligations using its highly liquid assets, like cash on hand, right? A ratio of 1.0 means you can exactly pay your bills.
Well, Nuvalent boasts an incredibly high current ratio of 15.27. So for every single dollar of short-term liability they owe, they have over $15 in liquid assets sitting in the bank. This represents a massive runway of cash reserves. This is their ultimate safety net, allowing them to operate at a heavy loss and burn that $275 million a year without facing immediate insolvency.
Let's move on to valuing the unprofitable.
We've established that the past and present offer no standard financial foundation, which brings us to synthesizing this continuing paradox. Look at the top row here, massive annualized price growth of roughly 41 to 49%. Now look at the bottom row. Net income growth is a flatline 0% across those exact same timeframes. The stock price is completely and utterly decoupled from current bottom-line reality.
So, we leave you with this final thought to ponder. If we cannot measure present value using DCFs or dividend models, and if every traditional valuation metric screams not applicable, investors must be playing a totally different game. They are placing a $7.8 billion bet entirely on the massive asymmetric promise of the future, likely hinging on groundbreaking intellectual property, clinical trial results, or future buyouts that the current financial statements just simply cannot capture yet. Thank you for joining me on this explainer, and keep questioning the numbers.